My name is Jake, welcome to the channel. In today's video, I want to talk about monthly dividend ETFs and stocks. So companies that pay on a monthly schedule and not on the traditional quarterly schedule. So most companies like Coca-Cola, Johnson & Johnson, McDonald's, those established companies that we're all very familiar with, these companies generally pay on a quarterly basis. And if you follow anything around dividend investing, you probably have seen a video around the top 5 monthly dividend paying companies, or the top 5, or the best, whatever it may be. This video is not going to give you a list of the reasons why you should buy these 5 dividend ETFs or these 5 monthly payers. The goal of this video is really to help you to think in a different way and not just blindly start investing into companies simply because of their pay schedule for their dividend. I shared this in a previous video of that I'm not a fan of monthly dividend payers. When I look at the topic at hand, talking about monthly dividend payers, it really kind of makes me feel like Big Ed in 90 Day Fiancé.
Oh my God! Whoa!
This has to be the weirdest experience of my life.
Nice? Oh yeah, nice.
Wait a minute.
Whoa! I'm done.
So my wife is completely obsessed with 90 Day Fiancé. I think anytime I look at the TV screen, she always has an episode of 90 Day Fiancé rolling. So yeah, there you go. So in today's video, I want to focus on objectively 3 reasons why you should avoid monthly dividend payers. And if I'm unsuccessful in convincing you to avoid them like the plague, then I'm going to also give you a few examples of a few that I think may be worth considering. So towards the end of the video, I'm going to share a few of the stocks or REITs or ETFs that I think would maybe be worth considering. But also at the end of the video, I'm going to show my preferred method of receiving monthly dividends. So stick around for that. To start off the video, before I dive into the 3 reasons of why I avoid monthly dividend payers, I want to share a real story. When I was in Germany, for those of you that follow the channel, you know that I've spent some time in Germany. When I was in Germany during doing my graduate in 2011, I was interested in finance. I was interested in investing, and I started investing into monthly dividend payers. One of the monthly dividend payers that I invested into was Interplus Corporation. It's a Canadian energy company. I invested into ERF right around the 23, 24 price point back in 2011. Wait, my cursor is off. Where am I at? There we are. Right around this price point in 2011. And I held on to this stock really through thick and thin. When it went up, I held on to it. When it went down, I held on to it. Unfortunately for me, I held on to it. And the longer I held on to it, the lower the share price went. But the share price is really not what's important to me. What's important to me is the dividend. What happened to the dividend? What happened to my monthly cash flow? So as you can see, the monthly cash flow got lower and lower every single month. And believe it or not, ERF was the better of the 2 that I purchased. I purchased another energy stock, and we can talk about how dumb that was, in hindsight, looking at how stupid that was. But whatever, whatever. I'm only human. I wish I would have invested in Tesla, right? So looking back, right, I know that was a dumb idea. But another one that I invested in is actually no longer on the exchange because they went bankrupt. Right off the bat, when I first, was looking into this, I had really bad experiences. So my opinions are a little bit tainted and maybe a little biased, but those are real life examples for me. Looking at, the opportunity cost, had I just, woulda, shoulda, coulda, if I would have just invested in the S&P 500, et cetera, et cetera. But what I'm getting at is I want to focus on the dividends here. Every single year, I was making less and less and less in dividends. And that is because this asset type, the investment that I invested in was not the most optimal way of generating cash flow. So you might be asking yourself, well, Jake, how do I know if a company pays a monthly dividend? There's a pretty easy answer to that. What you can do is there's a couple ways, and I'll show you a couple ways of how you can find that out. The easiest way that I know is to go to seekingalpha.com, type in the ticker symbol, and go under the dividends tab, under dividend scorecard, and you can see here, plain and simple, the dividend frequency, that this is on a monthly schedule. You're going to get paid monthly. If, for example, you go in and you type in McDonald's, McDonald's is on a quarterly basis. So you're getting paid a dividend on a quarterly basis. Okay. And if you're unsure of, okay, well, on what month does it pay? What you can do is you can go to the dividend history, right? And you can check and you can see, okay, well, what has the dividend history been? And you can see, okay, on what schedule they're paying it. So they're paying it on a March, June, September, and December basis. Okay, so that then you know, okay, if I invest in McDonald's, I'm getting dividends paid on the pay date on this schedule. Another way that you can search for dividend payers based off of the schedule is you can go over to MarketBeat. I'm not affiliated with them. I'm not a fan of their website, to be honest. I think it serves its purpose in that it gives great info, but the website is so annoying. Every 30 seconds there's a pop-up, and it's really, really annoying, and it makes me think of this.
Hey, Apple. Hey, Apple. Hey, Apple. Apple. Hey. Hey, Apple.
What is it?
Aren't you glad I didn't say Apple again?
So if you can put up with all the pop-ups, you can head over to the website here. You can check out and you can see, okay, you want to look on a monthly schedule. You can filter it a little bit by market cap. Over here, you can do it if, you know, the size of the dividend, what percentage you're looking for. And then you can search for the companies that pay a monthly dividend. I noticed that not every single company is on this list, so be aware of that. There's a few on here that I was searching for specifically that were not on here. So just be aware this is not, completely 100% accurate, but it's a good place to start. All right, so the first reason why I'm not a big fan of monthly dividend payers is because of the track record. So we all know that historical returns are no guarantee of future returns. We all know that. Typically, with monthly dividend payers, they pay a higher current yield, right? They have a higher current yield, but that yield is typically not sustainable. And these companies generally have a track record of cutting their dividend. And so what that means is if you're making $100 one year, they cut their dividend by 10%. Okay, now you're only making $90 a year. So that's something that you have to factor in and understand. And as your portfolio grows, fast forward 10 years, if we're talking about $1 million portfolio, right, that's substantial. And that's why it's important that regardless of the size of your portfolio, that's something to factor in and really take serious. So that's the first example. So with this example right here, you can see that this company has increased their dividend. They've decreased their dividend, increased it, decreased it. Like it's been kind of a bumpy ride if you've been an owner, a shareholder of Prospect Capital Corporation. Let me show you another example of a company that I used to own a couple of years ago is ANGNC. This is a mortgage REIT, the riskiest form of real estate investment trust out there. This is not an investment based off of the actual physical structure, but the mortgage behind the investment. Okay, so the actual mortgage. And so you can see the AGNC, they have a massive dividend. If we go over to the dividend scorecard, we can see that they have over a 10% dividend yield, current yield, but that's not sustainable. It's not going to be like that forever. And they've increased it, they've decreased it. And like the previous example, the track record of this investment is suboptimal. If we look at another example, we look at Shaw Communications. This is another example of a monthly dividend payer, but just the consistency has not necessarily been there. This is not a growth company. This company is not growing their dividend. And that's what we're talking about here on the channel is we're looking for investments that are growing. They're growing and they're rewarding their shareholders in the form of a growing dividend. The second reason why I'm not a big fan of monthly dividend payers is because of the high debt. In some cases, when businesses leverage debt, it's actually a good thing. They can use the debt to then grow and expand their operations. In other cases, for failing businesses or businesses that are struggling, like for example, the example that I used at the beginning of the video here with ERF or PGH, Pen Growth, it's another energy stock in Canada that went under, that I owned, unfortunately. That they were over leveraged and they weren't able to meet their obligations, and then their U.S. operations ended up going bankrupt, right? And so as a shareholder, I lost everything. Okay, and so the second reason why I don't like these type of investments is a lot of them are over leveraged. A lot of the monthly dividend payers are real estate investment trusts that are over leveraged, or also MLPs, master limited partnerships. I'm not going to go into detail into what those are. I invite you to go and do a Google search on what an MLP is, and if that's the right investment choice for you. But for me, these type of investments, they're not growth companies that are continually growing their dividend, like the ones that I talk about on the channel here. So that's the second reason of why I'm not a big fan of monthly dividend payers, is because of the high debt. They're over leveraged, and it's not always a good thing. The third reason why I'm not a big fan of monthly payers is when we look at ETFs. ETFs, it's really about the expense ratio, how much you're paying for, to have the ETF, right? And how expensive they are. And typically these monthly dividend payers, they're very, very expensive. If you go and you type a Google search, what are the best monthly dividend ETFs? You might see this one come up, KBWD from Invesco. It's a high dividend yield financial ETF. And if you scroll down from ETF.com and you look at the expense ratio, it has over 1.5% of an expense ratio. I mean, that's insane. If you look at that and you compare it to just the S&P 500, right, you're paying an incredible amount more to hold this investment. And you might say, well, Jake, you're getting a 12% dividend with this ETF, so it must be worth it. Well, when it comes to the total returns, in most cases, it's not. Total returns are the capital appreciation plus the dividends, the distributions, minus the expenses, right? And so with these investments, you're actually making much less. And let me show you exactly what I mean by that. So if you go over and you look at an expense ratio cost calculator, and you look at the expense ratio from investment one, the 1.58% versus the expense ratio of VOO. Let me show you here really quick so that we're all on the same page. If you look at VOO and you scroll down and you look at the expense ratio of 0.03%, and we compare a similar, scenario where you have an investment of $10,000 and you're adding an additional $1,000 a month or $12,000 a year with an average rate of return of, total return, capital plus dividend distributions of around 9%. And you look at that over 30 years, you look at investment one's going to almost cost you $500,000 compared to investment two, which is going to cost you just over $10,000. Okay, so the math doesn't lie, right? And so when you look at, I think the argument here is, well, Jake, you're getting a 12% dividend yield with that other investment. Yeah, but how sustainable is that? I said that back in 2011, and the company that I'm invested in today, that I invested in, no longer exists today. But if you say, well, an ETF is a lot more, risk averse, et cetera, well, you can also look at the total returns being, what you're actually getting at the end of the day. So these are just three examples of why I'm not a big fan of monthly dividend payers. So to summarize it really quick, the first reason is, once again, the track record. These companies or investments typically don't have the best track record. The second is the high amount of debt that these companies traditionally have. Not all of them, but a lot of them. And the third reason is the high expenses, the expenses that come with investing in these type of investments. It really makes it unattractive for me as a dividend growth investor who has a long-term investment horizon. These kind of investments don't really appeal to me in most cases. All right, so if I wasn't able to convince you about, maybe you're passionate about a few investments and I wasn't able to convince you to not, or to reconsider investing in them, I'm going to share with you a few that I think would be maybe worth considering. And in terms of full disclosure, some of them are in my real estate portfolio. They only make up a very, very, very small percentage of my overall portfolio. It's, I think, a third of a percentage point in my overall portfolio. So like 1/3 of 1%. So a very, very small percentage of my overall portfolio. But some of the, a few that I think would be maybe worth considering, on YouTube here, if you follow anything dividend investing related, you're probably going to be, you probably have seen SPHD. I've even talked a little bit about SPHD in the past. I think SPHD is fine, right? When we look at the three things that we just talked about, the track record, okay, SPHD has a good track record. If you look at the high debt, the companies that are in the ETF are okay, right? And then the third thing is the high expenses. SPHD actually checks off all three of these boxes fairly well. Right. And so that's why it's in this hypothetical portfolio here that I made in M1 Finance. This portfolio, just FYI, by the way, everybody, this is a pie that I built in M1 Finance. It's not one that I invest in. That's the cool thing with M1 Finance is you can build out these hypothetical pies. If I wanted to then add this to my portfolio, I could do that very easily. I would just go into my portfolio. I can show you really quick. It's pretty easy. Go over to my portfolio. I go here. I go to my pies. I'd click my dividend players with the kind of weird face, and then I would add it, and then I could adjust the allocation. So that's how I would be able to add this hypothetical pie that I built. All right, so looking at that, so going down here with LTC, Stag, Good, and O, all of these are in my real estate portfolio. And once again, they make a very small percentage of my overall portfolio. These are not bad. I mean, I think Stag and Realty Income are actually not really bad investments. I would never put all of my eggs into these investments, but I think that they're actually pretty good. They check off all of those boxes that we just talked about. Another ETF that may be interesting that I'm actually not, I think it's okay, is DIA. This tracks the Dow Jones Industrial Index, and it checks off all of those boxes as well when it comes to track record, talking about debt of the investments in the ETF, in the index, as well as the expenses, right? So for example, if we go over to ETF.com, we look at DIA, and we can read about, okay, how is the fund set up, right? It's pretty straightforward. It's following the Dow index of 30 companies, 30 largest US companies. And you go down here and you can look and see, okay, expense ratio is not bad. The ETF has been around for a long time. The assets under management, it's a pretty big fund, like ETF. It's very popular. A lot of people are invested in it. You can see the number of holdings, 31, and you can see how it's broken up by sector and by holding. Okay, so these companies, right? Apple, Home Depot, Microsoft, McDonald's, Visa, these are all great companies, right? And so with ETFs, really the big thing that I'm concerned about are really the expenses, right? The expenses, looking back here at the last one that we were just looking at for a second ago, over a 1.5% expense ratio with this ETF. Like this one, I would not touch with a 10-foot pole, right? Like that's how I look at these. If we look at SPHD here, for example, it's not bad, right? You can see, the expense ratio is fairly, it's well priced. I mean, it's not too crazy. It's a little bit more than what I like to pay, but I could say, okay, all right, if I absolutely need that monthly dividend cash flow, that's not going to deter me from investing in it. The thing that I'm not so hyped about with SPHD is the individual holdings, right? You look at the two highest allocated holdings in Iron Mountain. This is a REIT. I'm not so hyped about this REIT. I think in the short term they're going to do fine, but I'm not 100% sure. But I don't personally invest in Iron Mountain. And the next one would be CenturyLink. CenturyLink, they got a horrible track record of dividend track record. Don't invest into them. HR Block, not invest into them. A few of these others, right? So that's kind of the thing. I'm like, well, I wouldn't invest into some of these in the highest holdings. Why would I invest into the ETF? And so that's kind of the approach that I've taken when looking at some of these ETFs. But it does have some really high quality companies in there as well, right? Like with 3M. I don't know, just my 2 cents around that. All right, so I want to share with you all what's my preferred method of receiving monthly dividend cash flow. I would much rather invest in a high quality companies that are paying maybe on a quarterly basis, but spread out my portfolio so that I'm getting monthly dividend cash flow. For example, if I invest in Kimberly-Clark, I'm getting paid on January, April, July, October, and then so forth, right? If I invest in Procter & Gamble, I'm getting paid in February, May, August, and November. If I invest in a Johnson & Johnson, I'm getting paid in March. I'm getting paid in June, I'm getting paid in September, and in December. This is the way that I prefer to have my portfolio set up. And if you follow my channel, in one of my most recent videos here where I talk about building a $2 million portfolio, this is the approach that I'm taking with my portfolios. And so this is my preferred method of generating monthly cash flow. The way that I track my monthly dividend income is through Dividend.com's Propeller. Propeller is still in beta, so it's not in open access to everyone. I was able to get access to it, not because I'm special by any means, maybe special in different ways, given my, if you follow my channel, my humor, I guess I'm a little special there. But when it comes to the actual platform, I just was lucky. I registered and I was able to get in. And so the way that I track it is through this. So you can see how my portfolio is currently set up. And based off of the target allocation in my portfolio, I'm investing more in companies that pay on a quarterly schedule. That would be, the March, June, September and December schedule, as you can see here. If I go into the portfolio here and I click on my portfolio, a way that you can, if you have access to Propeller, what you can do is you can click on the upcoming payment in this section right here, and you're able to actually see when the payment date is, when you're going to be paid your dividends. All right, so if I would be curious of, okay, well, what dividends am I going to be paid here in September, right? And so I can see, all right, Aflac, American States Water, Intel, Pfizer, all of these companies, you can see over here on the status. Status declared means that it's going to be paid. If it says something, let's scroll down further. If it says estimated, that's what it's estimated to pay. It's not yet been declared or confirmed. So estimated versus declared. And you can see the total payment, the amount that I'm going to be paid, the ex-dividend date. The ex-dividend date is the last day that you have to buy in to get access to the dividend that's going to be paid on September, for example, September 4th with Honeywell, right? If I wanted to get the dividend per share of 90 cents of Honeywell, I'd have to at least bought in by August 13th to be paid on September 4th. So that's how that works. And that's kind of how I track my monthly payments and how I'm getting paid monthly. Now, of course, I could also go into M1 Finance and I can go into the activity field and I can see, okay, well, what have been my dividends that have already been paid in? What we were just looking at in Propeller are, dividends that are going to be paid in the future. Here under the activity feed in my M1 Finance portfolio, you can go in and you can see, okay, what has actually been paid out, right? And so in some of my holdings, I'm underweight and some I'm overweight. And so you can see that not every company pays the same dividend, right? With AbbVie, I have a larger stake in AbbVie relative to the other holdings in my portfolio. Like for example, with Clorox, a much smaller position in Clorox. This also has to do with the dividend yield. So the amount that I have invested and their current dividend yield. And you can see all the different dividends that have been paid out here in the month of August, etc. So it's kind of cool to track, forward looking, what are the dividends coming in, projected and declared, and what has already been paid. So I hope that this was helpful. There's a few examples and few reasons of why I'm not the biggest fan of monthly dividend payers. However, we did talk about a few that I think would be maybe worth considering. But really, if you're a new investor and you're considering, okay, well, how do I get monthly dividend cash flow? Going directly to the payout date is not always the smartest thing to do. That's not the first thing that you want to do. That is what I did back in 2011. Remember the story that I shared? Real life, right? When I purchased these companies and I held on to them and it just didn't pan out for me. So really understanding, is the investment a good investment, right? And we can always say, looking back in hindsight, we're always smarter looking in the past, right? And so going forward, when you're looking and trying to make decisions for the present and the future, remember those three things. Before you invest in a company that pays a monthly dividend, ask the question, does this company or does this investment have a good track record? How much debt do they have? Are they over leveraged, right? What industry are they in? Is this a real estate investment trust? Is this a MLP, master limited partnership? What kind of investment is it, and how how over leveraged or how much debt do they have. And if you really, really want to get badass and get really, really into the weeds, you can look at their short-term versus their long-term debt, because that does play a role as well. And then the third thing is, what are the expenses? If it's an ETF, understand that expenses matter, right? We shared the example of the one investment with the 1.5% versus just the S&P 500 over a 30-year time period, right? That equated to almost $500,000 just in the expenses. So really, those are the three things that you have to look out for. I hope that this was helpful. If you're new to the channel, I'd invite you to subscribe. If you liked today's video, give me a thumbs up, and I'll catch everybody in the next video.